would say, I'm actually in Barry's camp. I wouldn't be chasing, these kind of fumes that are bidding the market up today. The number I'm actually watching for, frankly, is 27.25, which would take us down to about a 10% pullback from the late July highs. I think we've had a crowding problem in this market, a positioning problem in this market. The tariff news, maybe it's not going to get worse. I think that's what we've heard over the last couple of days anytime soon. But it is materially worse over the past week. And we are about to go into conference season. We're going to hear companies talking about how it's getting worse, the impacts there. To me, I would look for that down 10% move.
So is it based on earnings expectations ultimately and how the tariffs are going to feed through? You think they're too high at this point?
I think there's first order impacts and secondary impacts. The first order impacts, I'll tell you, I personally was actually starting to feel a little bit better about 3Q and 4Q estimates. And what we heard, over the last few weeks, the tariffs are going to go up a little bit. So we've got some cost issues we've got to deal with there directly. That creates a possibility that you'll have downward revisions. We've also spooked corporates again, and that creates another opportunity for behavior to turn more cautious. We've seen a lot of emphasis on cost cutting this year to get to those flattish earnings we had in the first half of the year. I think you're going to hear more of that conservatism. But remember, a lot of companies have other companies as customers. And so there will be an impact, I think.
Barry, where are you on earnings estimates for next year? Already come down enough?
I think that the estimates are, I just think there's a big dispersion of range of outcomes around them. So if you think about what's happened over the course of this year, consumption fell off a cliff late in the year in response to the stock market crash. It was very much an echo of 1987 and 88. The same dynamic occurred. There was no leverage in the household sector. Consumption came back, worked through the inventories. Even this morning's inventory numbers look like they've been all drawn down. My thesis was that the manufacturing slowdown in the U.S. had less to do with global trade and tariffs and more to do with that unexpected inventory glut and then drawdown, and that if we got to this point, you'd see global trade start to recover and you would see U.S. manufacturing coming back. But as Lori described, we've had another business confidence shock. And so that business confidence shock is a major determinant whether we will get spending on software to surge the way it did last year, driving non-inflationary growth. Productivity rebounded sharply over the last 18 months. That could all stall. If software and research and development investment stalled out in the second half of the year, then next year's numbers are flat at best. And so we're at a big key inflection point.
So where does that leave us on valuation of the market and what's a fair multiple? So we're less than 4% off the highs, even though it's felt like a bumpy month of August. Much worse for some of the cyclical sectors.
Yeah, and look, I think you have to look a little bit beyond PE multiples. A PE today is not the same as a PE 2 years ago because of tax reforms. So I think historical comparisons are difficult. When you start to look at valuations with things like price to sales, price to cash flow, EV to EBITDA, things that haven't gotten sort of distorted by the tax impact, I mean, we're basically trading very close to levels that have marked the ceiling of this cycle. And if you bake them all together, our model says we're about one standard deviation above the long-term average. So we're not cheap. It's going to take more than a 4% drop. A 7% drop, I think, was the worst we saw earlier this month. It takes more than that to get that valuation froth out.